as you guys know, looking at the names on the panel, I'm Sarah Carlson with Fulcrum Financial, and we strive to give you innovative, honest, caring advice. And we have a really special guest today, so I like to call her a really big deal.
So sweet.
Quincy Krosby. I've always been a fan of hers. She's been an industry icon. She is LPL's chief strategist, equity strategist. She's new to our platform, and she has a vast history of incredible ideas and knowledge. Her past influence has been at Deutsche Bank Asset Management, Prudential Financial was most recently, and I think you were at Credit Suisse and Barings too. So very few, in fact, I don't know another woman in the industry that has your incredible pedigree.
Oh.
You're gonna, we asked you to come and share your thoughts on what's going on in the geopolitical movement. There's been so much change this year. And I know with you being an expert in those moving markets, I kind of just want to turn it over to you and you to share with our clients what your thoughts are with what's going on. And I believe we've had some questions submitted ahead of time, and you're going to address those as well. So let me turn it over to you. So welcome, Quincy. So excited.
Thanks very much. I wish I could be there. I know where you are. I've been to Spokane so often. What's not so wonderful is the geopolitical backdrop, really. So first we'll talk about the war, because everyone is interested in that, and the implications for the market, the implications for portfolios, because, you know, at the end of the day, that it boils down in our world of the implications. Now, I want to stress, I started off on a trading floor at Credit Suisse, and then I worked in derivatives, and then I came over to what we call the buy side of the business. That's the asset management business, and worked as a junior portfolio manager. This sounds awful to say, but I have to say it up front. The market has no empathy. So horrible things happen. Horrible things happen. I can remember the day that we had the shooting in Las Vegas of all of those folks, right? It was terrible, some years ago. And I was doing a client event, a live client event that night. And that's all people wanted to talk about. And by the way, by that time, the market had moved on. And folks are saying, Quincy, how is this possible? It was dreadful. The market dynamic is ruled by algorithms. 40 to 50, sometimes 60% of daily market volume is an algorithm, artificial intelligence. And what that means is, as you probably all have noticed it, how is it that the market moves so quickly up and down? The artificial intelligence looks at past wars, past shootings, and it makes a decision. Did we see this before? Do we know? Do we have an idea of how this is going to end? And then when it thinks it does, and in the Las Vegas example, it said, okay, this was a lone shooter. He didn't look like a terrorist, so we don't think there's any more, and that this is over with. And that's exactly what it was. It was over with. No empathy whatsoever. And it's important for everybody to understand that, because when I speak live, it's easier. I could see all of you. And I would say, I don't think I would want a stock market to reflect the emotions of, say, teenage girls. I could say that as the mother of 5. That would be awful, right? Up and down. Oh my goodness. So this is what's going on. Every day, yes, the market is still vulnerable and to headline risk. What's going on in the war? So, but on the days that the market is up, we usually had a sell-off, and the market, the valuations have come down, and you see buyers come in. A lot of it is algorithmically generated. I want to point that out, but managers are looking at the mispricing in the market. So what happens is you get a big sell-off. It's a horrible, horrible event. the market basically misprices many of the very good companies, excellent companies with strong balance sheets, good margins, healthy margins, and a bright outlook. They get thrown out, the baby being thrown out with the bathwater. It happens in the market all the time. And so managers and analysts will do their homework. They'll make the list of what they want to have in the portfolio. And it's quite common that happens. But nonetheless, the risk geopolitically is still there. And you'll notice that when it looks as if there's talks are going on, that perhaps the Russians have changed course, the market gets a breather and the geopolitical risk moves down. One of the ways we know it, for example, is oil prices will actually come down a bit. We'll start to see some of the sectors that are more associated with growth start to pull back up. So nonetheless, somebody asked this in the Q&A, where do we think this is going to go? Well, I think in the market's mind, such as it is that there will be a resolution at some point. We don't know how long. If Russia keeps at it, going after Kiev, for example, you're going to see fighting, and you'll have a brawl for a long time. But perhaps the Russians are happy just taking over parts of the East, parts that were pro-Russia anyway. There's something also going on, and that is a complete distrust of this Russia being at the table to negotiate. Many believe that the Russians are using it to buy time. Why would they want to buy time? Because it's interesting. Russian military lost a number of generals, key generals in Ukraine. If this were a US-led invasion, the next one up takes over right away. In the Russian military, that's not the case. They have to regroup. And so many believe that these talks is just an excuse for the Russians to regroup, because again, they've lost so much in terms of generals, leaders in the field. One other thing that the Russians are doing that fit their template is a theory of war, which is a confluence of resources and material. And by that I mean they will go in and they do this. They bombard, they surround, and they starve. Many believe it goes right back to Leningrad. Bombard, surround, and starve. And you could check all that off in Ukraine. But that said, the Ukrainians are fighting like nobody's business. So again, for the market is, okay, this could go on for some time. And this is the key, as long as it doesn't spread. Because then you've lit a match. You've already lit a match. You've lit a match. And with war, anything military, you light a match and you don't know really where it could go. If this were to somehow suggest that the next one on Russia's list is not just Moldova, which everyone thinks it is, but let's say Lithuania, let's say part of Poland, you got a whole new ball game. And then the market will take notice, because the big issue will be, are the Americans going to be involved? So right now, the notion is, you could see it, that the market is saying it'll stay in Ukraine. Maybe the Russians are happy taking a part of it. Ukraine says, hey, you know what? We don't want to sign up with NATO. We're going to be neutral. Maybe they can come up with a deal. At the same time, the Ukrainians are actually being given weaponry all the time from the NATO, US, all of NATO. And that obviously is helping them. So that's it. That said, what are the implications for the market? So you may have seen a headline today, and that headline is that Germany is worried that they're not going to have enough gas. Remember, they have a big gas pipeline from Russia. Russia is threatening to turn it off. The Americans are saying, look, we in America We'll supply you with more gas. We will work on it. We will get there, trying to wean the EU off of Russian gas, because they are, how do I say this? They're vulnerable. You're vulnerable to any provider that provides you with a basic need. So all of this has the overall markets also facing something else, which is a risk in the market. And that's a domestic risk, and that is from the Federal Reserve. There were a number of questions about the Federal Reserve. So if I may go over, what is the Fed trying to accomplish? But before I do that, the Federal Reserve is unique amongst central banks in that the two mandates for the Fed are price stability, that is making sure that inflation doesn't get to the point where it becomes stagflation, where it gets to the point where you could get wage increases, but guess what? The inflation is so terrible, you barely have enough to make ends meet. They need to find what they call a neutral level. And somebody also asked, Quincy, what's the level that the Fed would consider good? It's about 2%. These were very good questions all around, about 2%. The other, this is important, the Fed has another mandate that other central banks do not have, and that is full employment. The Fed has to fight these two battles, full employment and keeping a neutral level or getting to a neutral level in terms of inflation. The reason that these two are kind of at war, employment and inflation, is this. For the Fed to tighten, and keep in mind, this is not an absolute science. I mean, even what we would consider to be a science, which is medicine, American Western medicine, you go for a second opinion, a third opinion, until you get the opinion that makes you feel better, right? Economics isn't. You have history to help you. You've got what other countries are doing, but a lot of it is as much art form as it is science. Now, in terms of employment, we're actually doing pretty well. We've got a lot of job openings. The unemployment rate is below 4%. It's pretty darn good. And that's a major positive for the Fed to go in and try to fight inflation. Now, one of the things that contributed to inflation was the money that was poured into our economy. Billions and billions of dollars of money going to average Americans, trying to help them, going into businesses, trying to help them. That provided tremendous liquidity and an inflationary underpinning. Now, you might say, Quincy, but wasn't that a good thing? Well, yeah, you know what? Yeah, I don't know. It depends. I'm trying to be kind of cold-blooded about it, because what would have happened if COVID took over and the government just said, hey, guys, this is on you. We're not helping at all. Unemployment would have skyrocketed. And, when we look back over the last number of years at some of the events that brought the market down, whether it was the, technology bubble bursting, whether it was 9/11, whether it was 2008 and 2009, which was really bad. The fact is that, unemployment skyrocketed up to above 10%. And what we have noticed more and more is that Republican governments, Democratic governments are saying, hey, we don't want that. We don't want the implications of very high unemployment. Therefore, let's do something else. Let's think of other things we can do. And they brought the Federal Reserve in to help with that. And I like to say that what was once considered to be extraordinary is now considered to be ordinary. So one thing is the Federal Reserve buying bonds. They went out, not only this last go around, they bought bonds directly. We never had that. They actually went out. And why did they do that? In order for the market to believe that, don't worry, there's a buyer of last resort. It will be the Federal Reserve. Because if you're a company and you need to raise money, guess what? it could be 20% that the market is going to demand of you as a company. But knowing the Fed is there, you could bring the amount down. So this is what we saw in 2 years ago with COVID. The Fed going in directly and being a buyer. The other thing is, again, the money that went to individuals. The idea, and everybody knows what it was, is help support people. Working moms couldn't get childcare, so give them more money. Give people who were let go in the service sector, give them more money. It's very hard to wean people off of this once life becomes a little bit more normal, and that's a political issue. But just keep in mind, all of that money actually helps to feed inflation. And by the way, back in 2008 and 2009, Chairman of the Federal Reserve, Ben Bernanke, had talked about in an earlier speech about what he called helicopter money. If something goes wrong, sprinkle some money down with a helicopter. And you may remember, I think what did my husband and I get? Maybe $150 to go and buy something. And remember, at one point there was cash for clunkers. I remember that. I forget which downturn that was, but that was cash for clunkers. That was kind of supported by the government. But what then happened was Ben Bernanke started quantitative easing. And this is where the Federal Reserve goes out and buys bonds. They buy bonds in order to push interest rates down to zero. And the reason for that is to help kickstart the economy. And so Ben Bernanke had an awful lot of explaining to do of what it was, how it's going to work. But his point was, we need to do it. We got to do something to kickstart the economy. And lowering rates wasn't enough because they had lowered rates. They needed more than just lowering rates. It was, we'll buy bonds and it will bring the rates down to zero and even lower than zero, actually. And that's what happened. Then, you might find this interesting. I hope so. Janet Yellen comes in. She finds it very hard to raise rates. There's always something going on with raising rates. Back then, she wanted to raise rates, and China had a problem. She delayed the rate hike cycle to normalize interest rates. And then Jerome Powell comes in. Now, this is important about him. He's not a PhD economist, and I think that's kind of good. I think it's kind of good. He has experience working in capital markets, and he was a lawyer, but he'd been a Fed governor for a long time. And while he was a Fed governor, he would give speeches, and the speeches went like this. You can't have low rates forever, because what it does is it forces risk-taking. Risk-taking in terms of buying real estate. Hey, it's so cheap. Why not go out and buy a lot of it? Get mortgages. Go ahead and do it. Portfolio managers desperate to give their clients yield, taking on more risk. Pension funds, by the way, having to give returns for folks who are retiring, taking on much more risk. He said, if this keeps going like this, you're going to have a bubble and it's going to burst. So when he came in as Fed chair, he embarked on a process of rate normalization. So if you want to know his thinking, this is it. We need to bring rates up. His view is now, it isn't just about normalizing rates. It is about trying to kill inflation. And his biggest worry is that this inflation turns into stagflation, which is the following, that you have no growth and yet you've got inflation. That is something that is pernicious to our economy, absolutely pernicious. So he raised rates at the last Fed meeting. And what was interesting about it is that following the meeting, all of a sudden, he's out on the road speaking twice. 5 other Fed members were also out on the road speaking. And they had one message, because you know that they did it deliberately to get them all out there and said, hey, market, in case you didn't understand what we were saying, we're serious about fighting inflation. We're darn serious. Don't think we're not serious. We are going to do it. And every time that message was ramped up, the market sort of pulled back and said, oh my gosh, maybe they really mean it. But the market was thinking, hey, wait a minute, look what happened to him in 2018. I think it's healthy for us to know this. He starts raising rates. And by the time we got to November of 2018, the 10-year treasury yield was over 3%. Then we get to December and they go to a Fed meeting and he's raising rates again and even suggests that, you know what, I think in 2019, he said, we're going to have more rate hikes. We're normalizing rates. In December of 2019, folks, the market had one of the biggest downturns for a 1-month pullback that we've seen, almost 19%, just a little over 19%. And a lot of it came on Christmas Eve. And you say, well, Quincy, how can you remember Christmas Eve of 2018? The reason was everyone was coming to our house for Christmas Eve. And I'm in the kitchen poaching salmon. The market was tanking. It was dreadful. And we had family and friends coming in. And, you know, having come from a trading floor, I always remember everything that the guys would always say. Always remember, you can't lose money when the market is closed. And on Christmas Eve, the market closes early. But it was gruesome. This is what happened. This is what happened. Go from Christmas to first week in January. There is a meeting of the American Economic Association. Chairman Powell is there. Before the market even opened on a Friday, it was the Friday that we were getting the employment numbers. He made a comment. This was the comment. The Fed is going to be patient. That is code for we're not raising rates. That's code for not raising rates. I mentioned algorithms before of how they swoop down. They hear everything 24/7. The algorithms came into the market like a tsunami. And the futures market, because we weren't open yet, it wasn't 9:30 in the morning, it was before that. The futures market just shot through. Not only did the Fed not raise rates, they lowered rates in 2019. But did the market have a hint that the rate hike normalization was going to be difficult back in 2018? Sure. And this is why we're watching that today. We saw housing related stocks down early on when he started raising rates in 2018. Anything associated with the auto industry started to come under pressure. And then we always will hear people say, you know, banks love higher interest rates. Of course they do. Banks need it for their net, what they call the net interest margin. They lend out here, they get a higher rate coming back. They love it. Insurance companies love it because they can match their assets with their liabilities. So if you look at an ETF, like the XLF that has big insurance companies and big banks, that usually does very well when rates are rising. But this is what happened in November of 2018 when the 10-year yield went above 30%. And this was something that I'll never forget watching this. Yeah, the financials did well. The XLF went up, but so did utilities. The XLU went up. They were both up there together as the 10-year yield went above 3% to about 3.2%. They both loved it. We knew that only one of them could last, not both. And what happened was, after that, the financials suffered and the utilities got a bid. People were going into utilities. You know why? Because the people who work in the market knew that the Fed was raising rates at a clip that how are the banks going to make money? If mortgage rates are going up, if you can't get a car loan, if your credit cards are going higher, people pull back their spending. The economy slows and you're setting yourself up for a recession. So that's what happened. And I think that the Fed got the message, or they, as they say, they got the memo. Guess what, guys? You're pushing us into a recession. So now it's different. There's a lot of inflation. And how do you kill inflation? So I'm taking another question because I think somebody asked about supply chains. Well, yeah, what happens is because of COVID, also because of the war. Supply chains have now gotten choked up even more than they were during COVID. And you're looking at somebody, we sold our farm. We lived on a farm for 26 years. We sold it. We moved without our appliances, and we're moving into a house in the South. And I can't get appliances. I can't get the ones that fit into the kitchen. They say that they're on a boat. Well, I was, where's the boat? I'll write to the boat. I'll go to the boat. I'll go with wherever the boat is. I'll go there with the U-Haul. This is crazy, right? Well, I'm not used to this. In addition to that, we have oil prices up. Now, you guys, I think out west don't heat your houses with oil. The Northeast does, but at the filling station, you know how much that is. What that does is it chokes off our spending on other things, what we call discretionary spending, things we don't have to have, but that we want to have, if it's all going into your vehicle. So that's another issue that we're facing. The economy is facing. The Fed believes that it could deliver a soft landing, meaning, yes, they may give us a 0.5% hike, not 25, a quarter, 20, we say 25 basis points, that's 0.25% that they gave us. They said that we could do it at a half, 50 basis points. They may have to do it a number of times, sort of like injections, but they say our number one goal is to fight inflation and deliver a soft landing. We don't know if it's going to happen, but the fact of the matter is, at least, and this is important, at least our economy is still solid. We have taken at LPL, we have inched down a little bit on our assessment on growth, but not to the point of calling for a recession. We believe that as we get out of this next COVID wave, Americans are going to continue to spend, granted, on experiences. I'm booking travel, and it's really impossible to get a seat sometimes if I don't book very quickly. Americans want out. We want to go out. We want to go out and enjoy life again. So we have Americans who have jobs. The job market is good. Job openings are good. And that is a positive to go into a rate hike cycle where the job market is good. Now, you know the expression, you could have too much of a good thing. So leave it to economists. And I admit I have a PhD in economics. So I don't mean to depress everybody, but this is it. Wage growth is moving higher. Companies are forced to raise their wages. And what happens with that is, if you know that your neighbor got a higher wage, right, got a raise, you might think, hey, you know what, I'm going to go see if I can get one where I work. And if I don't get it, guess what, I'll just leave. The latest data indicates Americans are leaving their jobs like crazy, but they're getting other jobs. Guess what, where they're being paid more. But that means that then other companies feel like they could raise their prices. So you've heard of wages go up, prices go up, wages. That, folks, is the inflationary cycle. And I know from going food shopping, I look at some of these boxes and there's hardly anything in there, but they've raised their prices and they've lowered the amount of food that's in the boxes, like cereal. It's going on across the board. I sometimes go to Old Navy. I've got 2 sons and 3 daughters, but I always like going shopping for them. And I bought myself some shirts there, men's shirts. I thought, this is Old Navy? Whoa, this is expensive. That's what's happening. Just to put it in everyday language of the world we live in. The Fed has to navigate this. And then at the same time that they're doing that, the Fed is also going to be reducing liquidity in the market. Remember I talked about all those bonds that they bought that took their balance sheet way up from just over 1 trillion to $3-4 trillion and more than that? They are unwinding that. They're selling that off. So liquidity is coming out. In the market's mind, it is a form of tightening. So the market is saying, hey, Federal Reserve, not only are you tightening by raising rates, you're also removing liquidity by getting rid of those bonds from your balance sheet. That's another form of tightening. How's this going to work out? So there you go. Now, good news is, though, don't think that the folks at the Fed just only listen to each other. They listen to economists who work on Wall Street. They listen to people who work in the market itself, not just economists, but guys who, ladies, it's generic when I say guys, who work in the treasury departments of the banks, in the stock market. They follow this very much. And they do not want to lead us into a recession. So that may mean he may be forced to come out. The Fed may be patient. Right? No one was expecting that in January of 2019. So they don't want to kill the economy by any means. They just want to slow it down a bit, get some of that inflationary pressure out of it. Once the supply chain opens, right? Once it opens, we should have more competition in terms of prices of things we can buy. I know the appliances that I'm buying, they're not fancy. They're not coming from Germany. I wouldn't even know how to use those things. You need a PhD from MIT. No, I'm buying regular American-made appliances, but the prices are much higher. So the notion is when the supply chains open, then the prices will come down. Now, lead me to China on this, because China has had to close down a good portion of the country because of COVID outbreak. They're opening up a little bit more, but some of the manufacturing areas are closed. And even though I go back to my little situation of my appliances that I think are made in America, not so fast. Some of those parts come from China, and they can't get those parts. So there you go. That also hinders the supply chain. So all of this leads to an economy, a global economy, facing multiple resistance points. What's the war, energy, commodities, central banks, not just America, but central banks around the world wanting to start raising rates. Because if you don't raise the rates, also, by the way, what happens if something really horrible happens again? The Fed doesn't have any little rates in its toolkit, which they call it a toolkit, by the way, in order to lower rates. And that would mean they'd have to go out and do something extraordinary again. So you get the point. So that there you are. So again, in China, they have had to lower their earnings. They've had to lower on the companies that we follow. They've had to lower their GDP, and there's a question in the geopolitical front as to what are their plans. What are their plans? What are their plans as far as Taiwan is concerned? I don't want to be so depressing, but it's kind of part of my job to be depressing because I have to follow this. I'm also a former U.S. diplomat. I watch all of this. In terms of Taiwan, you may have seen it. They're sending more and more planes over, deeper into their territory. Yeah, their view is, hey, Taiwan, that's ours. That's ours. And look what they did with Hong Kong. Most folks don't realize that when the British turned over Hong Kong, it was supposed to be 50 years from the day that it was turned over before they went to the mainland, that they joined the mainland. Boy, it didn't take, I wonder, was it 50 days that the warnings were coming? And now it is. It's China, mainland China. Mainland China feels that way about Taiwan. So we've got Taiwan Semiconductor, which is the biggest producer of chips, silicon chips. You wonder why car prices are so high. One of the reasons is on the supply chain, there are fewer and fewer silicon chips. It's easing a bit. It is easing a bit. We should see prices beginning to come down. I noticed that used car prices have begun to come down a little bit, and that would lead us to believe that new car prices might come down. But Taiwan Semiconductor has been building a major facility in Arizona, which is very good news. But China doesn't have much of a silicon manufacturing capability. And of course, there's no doubt that they look to Taiwan Semiconductor, how wonderful that would be for them. So this is a geopolitical risk, by the way, that hovers over us tremendously. There's a debate amongst folks who analyze this as to it's not if, but when. And China would like to do it. How do I say this? The nice way. In other words, put in a leadership there that says, okay, we'll do this with you, we'll do this with you. And then ultimately, just like in Hong Kong, here you go, here are the keys. Or it'll be the hard way. You know, sometimes with my kids, I would always say we could do it the easy way, or we could do it the hard way. So keep our eyes on that. Getting back to us here in the United States, we look at some of the areas that we look to invest in. And this is something about when we say what's happening in Ukraine right now, defense stocks, right? So as the war was heating up, the defense stocks were also, the share prices were going up. And on a day-to-day basis or minute-by-minute basis, what we see is the defense, as if the headline hits that they're talking more, that everybody thinks that both sides are really trying hard. The defense prices come down. Fact of the matter is defense spending is up all over the world. Germany, which we know enjoyed the US largesse, that we took care of a lot of their, what shall I say, well, we were the ones that spent the money on defense. They have doubled their budget. Around the rim of the EU, all of them are upping their defense spending. The fact is that China, for example, they have the hypersonic missiles. We're behind in that. And from what I'm reading, what I'm hearing, we're starting to focus on it. Like, hey, we've got to start on that. And you know, the names, I won't go into the names. It's the Grumman, Lockheed Martin, so on and so forth. But that's an area that is I believe is going to continue to do well despite the up and downs as the defense names, aerospace and defense names follow the minute by minute headlines in the war. So the other area is energy. It's fascinating. I know there are folks who really want to go green. They say this is an opportunity to go green because after all prices are so high. You know, there's a saying in the market, if you want to bring down the price of anything, keep pushing the price up. Higher the price, ultimately the price starts to come down because folks say, hey, forget about this. I'll go find, I may not use, cornflakes, color cornflakes because the price went up. I'll find something else. I'll find a substitute for it. So, but the point I want to make though is in energy, you can't go to green. The transition, it's a huge transition. I don't even know when we lived up on the farm. I have no idea if I had a hybrid, where would I go and plug it in? There was nothing. It was all fossil fuel. So you have to have a transition. And you know, the U.S. Was a truly energy independent, and we sort of pulled a little bit back from there. We don't get much of our oil, by the way, from Russia. If we import it all, it's from Canada. They're the major source of our imported oil. The oil market is a spot market. All the oil just comes in and Russian oil goes into that spot market. We know that China is buying Russian oil. We know that India is buying Russian oil, but the goal for the US and NATO is to cut the cord on Russian oil for the West. So we'll see. But again, they are so dependent on Russian gas that we have to step up to the plate if we're going to lecture them and say to Germany, hey, we don't want you doing that. We better give them enough gas that they don't have to worry about freezing to death come next winter. In any case, just again, looking at this market, a couple of things that are positive for the market. Let's go over that. One was the mispricing of the stocks that were just sold off as everything got sold off. Tremendous mispricing. And that's good news for portfolio managers and the analysts they work with. Second, you may have heard the term of share buybacks. That is when companies buy back their shares, their stock from the open market. That number has gone up. So that last year, 2021, was the pinnacle of share buybacks when American companies bought back $850 billion worth of their shares. Expectations are that this year, that number will cross $1 trillion. Why is that good news? Now, there's a lot of political debate about it, so I'm not getting into that, but I'm just telling you from the standpoint of the market. It's that it takes away the shares that are outstanding, and that means that each share left is worth more. So that's good news. And one company after another has been announcing it. The other thing that we're seeing is that dividends, those of you who like dividends, I like dividends very much. They're being sweetened. Companies are upping their dividends. And I think that's good news for the markets. So these are all kind of underpinnings and catalysts for the market. Ultimately, it is about earnings, as it always is. And one thing about American companies, they know how to deliver earnings for clients. The negative, and I don't really consider what I'm about to tell you a negative, and I'm going to close off pretty soon. And it's this. I told you that Chairman Powell used to give speeches a lot when he was Fed governor about the negative part of low interest rates, zero interest rates, that it created risk. It meant people could go out and just buy this and buy that, not thinking that rates could ever go up. Well, what happened in this country recently is many companies were born. They were born. Money just poured in to create these companies that don't make any money at all, still don't make any money at all. There's a term in economics that's called creative destruction. And it means that companies that shouldn't be alive need to just go away, cleaned out, and new companies should come up. And that is something I believe is going to happen because we saw so much risk-taking over the last 2 years as money was plentiful, liquidity was plentiful, rates was zero, that we saw companies being born that still do not make a dime, and they're questionable leadership. Those companies may in fact go under or be taken over. That's healthy. That's actually a good thing. And I'm one that believes that you need more of it. We got our geography spread in this call. For many years in Japan, after World War II, they were not allowed to fire people. Unemployment was just absolutely not allowed. And so the banks were forced to keep lending money, giving money to companies that were called zombie companies. They just kept people working. They borrowed money. And finally, the Japanese, in order to modernize their economy, finally allowed unemployment to exist, and then cut the cord, told the banks, cut the cord. We've got to get rid of these zombie companies. So we don't want that kind of thing to happen in this country. That's not how capitalism was born, and that is not how capitalism is going to remain so vibrant in our country. And in closing, let me leave with this. April 1st, 1976, something major happened. And that was that the Apple Computer Company was born officially. They were officially the Apple Computer Company. And of course, they were working in 1975 rather. America was in a recession. By the time we got to 1976, we still had unemployment above 5%, between 5 and 6%. Inflation was still high, and yet Apple was born. But here's the comparison of where we are in this country compared with other countries. Do you folks know the name Alibaba? Alibaba is a major Chinese company. They are in everything. They're kind of like the Amazon of China. Jack Ma was the darling of Wall Street. He would be written up about all the time. He'd see him on the shows, talking about his company, talking about his vision for China. Guess what? You don't hear from him anymore. He was shut up. Maybe he's a shut-in now. We don't know. but you don't hear from him. The Chinese authorities have basically said, you're not talking anymore. You're not going to be seen anymore. That's not the American way. These guys still come out. They still talk about what they do. They criticize the government. They criticize the potential taxes on them, back and forth, but they're allowed to talk. They're allowed to think. And most important, they're allowed to create. That's the America. That is the entrepreneurial spirit. So in our portfolios right now, we look at the United States of America, right? The majority of our portfolio is in equities in the US. My view is never short the US companies, never short the United States of America, because going around the world, serving our country around the world, there's no place like home. We get it done, and we will get it done, and we'll persevere. Just think of Apple. Steve Jobs, Steve Wozniak, and Ronald Wayne, three of them creating this company. Not necessarily in the garage. I think that was like a fable, but still not working in a fancy office. And then the Apple computer in 1977 became the largest selling computer. I'm on an Apple product. Another one is sitting on the bed. That's my phone. All American spirit. Can do. China, you can do, but then you won't do. So I rest my case. I can't thank you enough for inviting me on this call. I hope I answered your questions. And I just say to this, we just persevere, we focus, we persevere. That's what we do. We will get out of it. And we have a market that has no empathy. Always remember that. It looks through everything. We have empathy. Your advisors have empathy, but the market doesn't. And we trade and invest in the market we have, not the one that we want. That's how we get it done. That's how we retire with dignity, because we take a look and we say, what is best for the portfolios? So thank you again. I don't know if there are any other questions that we can touch upon in the last few minutes.
Yeah, that was fantastic, Quincy. Thank you so much. I mean, it's so helpful to, you did such a fantastic job of winding in historical perspective, of understanding the macro, fundamental underpinnings of looking at the equity landscape. I think you did that was wonderful.
Thank you.
I love the last part where you said so much of the trading is AI coming in and making those trades, and yet ultimately it's the empathy and that creative thinking, that human element, which really helps to differentiate and help us persevere through these difficult times. So thank you. It's such,
Thank you.
I'm so glad you're on our team.